Hello and welcome to our fireside chat. I hope you enjoyed the jokes as much as I did. I'm Danny from Paddle. I'm joined here today by Paddle's very own CFO and resident tax expert, Hugo Grimston. Also joining us is Ben Murray, leader of the SaaS CFO community. Hugo is the person responsible for the tax compliance of all of our sellers through the Paddle platform. And Ben has more than 20 years of experience in finance and operational management. He's worked with small companies, he's worked with massive multi-billion-dollar global organizations. So between the two of you, you've got a lot of experience when it comes to the question of navigating sales tax liability, which is what we are here to talk about. We've got just 33 short minutes, but before jumping in, to those of you watching, please do ask any questions you have in our Q&A box. You'll see that at the bottom of your screen. We'll try to squeeze in as many as possible, but if we don't have time to reach a question that you've asked, we'll be following up directly with you. So, moving on to what we're here to talk about, sales tax. The regulators of the world have been playing catch up in the last, I'd say, 6 years when it comes to online ways of doing business as a whole. My opening question for you both, perhaps starting with you, Hugo, is what has this looked like in relation to the SaaS industry when it comes to tax in particular?
Yeah, sure. Thanks for the kind intro. Yeah, and I suppose that the great thing about software and SaaS in general is that you can be global from day one. And since cloud became the default way of delivering software, a lot of software sales are cross-border, and so in the olden days, cross-border goods were not taxed, but governments have got wise to software as a big market and potentially a big source of revenue. So I guess the big changes over the last few years have been around kind of leveling the playing field globally from a tax perspective. So it sort of started with the EU, with the Vatmos Scheme, which many of the audience will probably be familiar with. And the idea behind that was to ensure that the kind of tech giants didn't set up in Liechtenstein and dodge tax either from a kind of consumer or a kind of their own personal, the company's perspective. And then what we've seen since then, which was in the kind of 2010s, is like a lot of copycats in terms of jurisdictions trying to get their hands on tax dollars. And then the other massive change was in 2018 around the US, which I think Ben is probably going to speak a little bit more about. But that is probably other than the EU, is the biggest thing that has changed for tax of SaaS globally. And it means that not many companies can avoid sales tax, whereas in the past it might have been possible to get by without charging sales tax if you were B2B. Yeah, so I think it's a global phenomenon. There are, I think, 60 countries that charge sales tax now on software and SaaS, and yeah, it's only going to get bigger. So it's a huge issue for CFOs of SaaS businesses, and it's only going to become more of a headache.
Yeah.
So Ben, what has that looked like over across the pond?
Yeah, absolutely. As a practicing CFO in the US and having collected sales tax, I'd say it's constantly evolving, especially as software has evolved, right? From before off-the-shelf software, kind of a good that you download, and sometimes that was taxed, not taxed, depending on the states, and then shifting to ASP, now to SaaS. So it gets in the US very technical as the software and the technology has changed. And staying up with that has been, it's pretty tough for small businesses, I'd say, in the US, because the states are different and the technology has changed, and how software companies are delivering their service or their software, if it's on-premise subscription or hosted in different states or different countries, it gets pretty complex to try to understand how my offering is taxed in different ways.
So there might be people in the audience here, hopefully not, given that they've tuned in, asking whether this is something that a business of their size needs to be worrying about. So Hugo, question for you: who in SaaS does need to worry about this, and why?
It's a good question, because I guess there are kind of gradations of or types of business where it's much more applicable, and types where it's less applicable. And before the US had the kind of Supreme Court ruling back in 2018, the general rule of thumb was that B2C software is taxed. So and B2C can touch B2B businesses at the lower end, because in order for a transaction from a tax perspective to be B2B, the person buying that software, or the company buying that software, needs to be registered for sales tax, and clearly not all businesses choose to be registered for sales tax. But yeah, I think the huge change is the US. So the US, when the concept of economic nexus kind of became not law, but adopted by all the states following, I think it was South Dakota, who sued Wayfair and took it to the Supreme Court. As soon as that happened in 2018, the concept of economic nexus, so you didn't need to have a physical presence or visit any state to, you just need to make some sales, maybe $100,000 or something into a state. And in the US, most states don't distinguish between B2B and B2C. So I guess kind of the shorter answer to your question is, if you sell B2C globally, then you need to worry about sales tax everywhere. If you sell B2B wholly enterprise, then you probably only need to worry about the US and a couple of smaller jurisdictions like Russia or Switzerland, where B2B is taxed. But if you're somewhere in between, you probably have to take a kind of country by country view, because you may be selling to consumers without necessarily knowing it.
And so, Ben, in your experience, what do people know when it comes to selling into the US in particular?
That you have a lot of different states with different tax laws and code, and each state is a little different, which makes it so difficult. And I saw a question in the chat that, yeah, the US even has more jurisdictions. It's not just the states, but you also have to consider county taxes and local taxes. And sometimes you have to remit that to the state and they disperse it. And sometimes you have to remit directly to those local jurisdictions, and every state is different. So I think, one, you have to know, what are you offering? What kind of service are you offering? How is it being delivered? Because there are fine lines and nuances on what's taxed and not taxed in each state. And also, it used to be kind of just, I wouldn't say a rule of thumb, but you think, hey, services, never been taxed, right? And there are some states like Washington, whether, hey, if it's bundled with software or unbundled, you could get tax on services. So it's even changing, I'd say, for service organizations as well. So you have to know what you're delivering, where your customer's located, to really dig in to understand your tax liabilities.
Would you say that the US is one of the most complicated then in the world? Or Hugo, are there any other countries out there that kind of rival, or at least we should be slightly scared of when it comes to sales tax compliance?
Yeah, I mean, no one gets close to the complexity of the US. It's, yeah, I think there are something like 17,000 tax rates or something in the US. I heard somewhere. I don't know them all, obviously. But no, so, I guess the US is unique because you've got each state, which is a kind of separate entity unto itself, and they all have very kind of quirky rules that have been kind of developed over the centuries. I think in the rest of the world, there are some jurisdictions which are super easy. So the EU with the Vatmos Scheme is incredibly easy to apply for and submit tax, and it's very, it's just very clear and very well worked through, and that's a function of the fact that it took them probably 10 years to put the legislation in place, because they obviously had to get the agreement of every single country in Europe, which is obviously quite difficult to do, and then you get some at the other end which are kind of brought in the tax as a knee-jerk reaction, didn't think through the kind of logistics correctly, and just made a kind of mess of it. So the one that springs to mind is the UAE, so Dubai, and the kind of the Emirates. They, we at Paddle, because we deal with sales tax at kind of scale, we were one of the first international companies that tried to apply for sales tax in the UAE. And it was like a horrendous bureaucratic procedure. Everything had to be translated into Arabic. We actually, we kind of hit a dead end, had months and months of discussions with the tax authorities. Then we engaged one of the big four to help us to kind of actually get kind of registered. And then by the time we actually got registered, we were late with some tax. And so rather than saying, well done for trying to get registered and actually be compliant, they hit us with a 200% fine on our back tax. So it was a horrible, a horrendous experience, and not one that I'd like to repeat. But for example, we're currently going through a similar process in Saudi Arabia. It seems that maybe the Middle East is the most painful in terms of registration for sales tax.
So how are businesses currently dealing with this challenge from what you've seen?
Yeah, on my side, when I surveyed my audience, and my audience, primarily say US, Canada, Europe, 60% of the respondents said NA as the response. So are you using sales tax software to be compliant to remit your sales tax? And 60% said NA. And I can only assume, and I don't know, in that NA, is it just, hey, are we ignoring it? Or we truly know that sales tax is not applicable to our company, which I kind of feel like it's more like NA, that I'm not really sure we're not doing it, and not sure, if we should be doing it, versus, yep, I checked and I know sales tax is not applicable in my jurisdictions. And, even surprisingly, looking at the poll results, when, by ARR size, in the 11 to 50 million ARR range, half the respondents also said NA. So it just, you wonder if they're just ignoring it, not sure, or have never taken on the complex challenge of understanding what liability they may have.
That seems very risky. From our experience of a 200% fine. So, I mean, what kind of resource, if people wake up to the fact that this is something they do have to deal with, what kind of resources are available to them to do this in-house? And what are the options if you don't have that resource?
Yeah, I think it depends on what the exposure is for any individual company. So I think that if you're selling domestically, for example, then you can probably handle it in-house pretty well, other than the US because it's so complex. But you can probably handle it in-house. I think most people would either take a kind of hybrid approach. I'll come on to what that is in a second, or use a service like Paddle, as a merchant of record or reseller. In terms of the kind of hybrid approach, it would probably be they would administer some of the easier kind of jurisdictions themselves. And this assumes that they're not necessarily selling globally. So if they're selling in Europe and a couple of other big jurisdictions, then they can probably do that themselves. And then, but for the US, they would probably use either an advisor or kind of a tax solution, a kind of software solution out there, just because it is so complex. And then there are some jurisdictions where you can't actually do it yourself. You've got to use an agent. So yeah, I think doing it yourself, it is possible at scale. It's obviously much easier if you're B2B. And if you're enterprise B2B and you have a presence in every country because you have a sales force out there, then obviously it makes it easier. I think if you're selling from your home country to lots and lots of countries, abroad, then you'd be a bit crazy to do it yourself, just because it's so complex, and it's the penalties for getting it wrong, or the kind of the cost of getting it wrong is so high, because you've got all the tax that you haven't charged your customers that you'll then have to kind of try and reclaim, and then you'll have fines and back tax and all that sort of stuff. So yeah, either a hybrid approach or a kind of using a reseller is the easiest option. And
so questions come through which sort of relates to this, and I'm going to aim it at you, Ben. So as a question, a SaaS company may be headquartered in a city but have customers from all 50 states. Do we really have to study each state's tax regulation just to find out if we are liable to any taxes? Even accountants are still not too familiar with how technology/software companies are taxed. The legislation isn't catching up as quickly as the technology is advancing. Over to you.
Yep. Yeah, unfortunately in the US, right, it's so complex. You even if, say, I'm located in Denver right now and selling to all 50 states. You have to understand the tax regulations in all 50 states for your product and service. So it is such a pain. And you see some companies hiring tax experts, but I wonder only maybe if they're a tax expert in your solution, because right, so many products and services out there, and plus the reporting of sending reports to the state, sending to the city, to the local jurisdiction, to the counties. Each state is different. So doing it in-house for a small business is super difficult. If you're Fortune 500 public company, you probably have payroll tax experts, sales tax experts, or for a small company, really you have to. I relied on sales tax compliance software, to do the study, each state, what I was offering, and then, handling all the filings to those states automatically, which for me was a no-brainer, because I just don't have the time or resources to do it in the States because it's so burdensome.
And is there, Hugo, you might know this, is there a central repository where the audience can go and check the different national sales tax rules, rates and potential penalties for non-compliance?
Yeah, there are various there's interesting reading you can do and resources online. I mean, I guess what makes it quite daunting for people is that if you look at EY's or PwC's indirect sales tax guide, these sort of white papers run to like 1,500 pages. It's like, no one has time to read that sort of stuff. So yeah, you can inform yourself on all this sort of stuff, but it's like, do you have time to Ben's point, to kind of really understand the nuances of each jurisdiction for each type of product? If you're selling globally, I mean, I'd say that most SMEs, or even medium-sized businesses who are doing tens of millions of dollars in revenue, just that's not their core competency. That's not what you should be spending your time on, or your finance team should be spending their time on, because there are ways of doing it which are better.
I've had a question through from Dwayne, who's in the audience. Any comments, thoughts about the ability for a B2B SaaS vendor contractually putting the onus on the customer to self-assess and remit? Don't know if that's something that either of you.
I can have a stab at that. I think you can do that. I think it depends on how many customers you have, because ultimately it's your responsibility as the vendor of that software to collect and remit sales tax. So if they refuse to do it, or you don't get it off them, then you're the one with the liability. So yes, it may be an approach if you're only just over a threshold, and you're doing big, very, very large contracts. But I think if it's if you're doing hundreds and hundreds of these, then that's just not a scalable model. And you can't expect a customer to kind of comply with that if they're not sophisticated enough.
Absolutely. Yeah, I wouldn't want to put that onus on my customers to figure that out. And plus, what if they get the rate wrong, don't submit, etc. So still, I think it comes back to you, because you could be, as an entity, registered in different states, doing business in different states, and ultimately they're going to be able to figure out how much revenue you have in those states, and if you're liable for some of that stuff. So really, as a CFO, I'm not going to put that burden on my customers.
And how? So this is another question that's come through. How does this impact Canadian-based companies selling into the US? I think I can guess this one, but perhaps Hugo.
Yep. So once again, I'm not an expert on exactly what Canadian kind of software vendors will need to do from the US perspective, but clearly, given that Canada is closer to the US, I think the US looks at Canadian software businesses slightly differently from other people from other countries. In essence, from a sales tax perspective, there is no difference. So the rules are the same as for if you're from the UK or anywhere else in the world. If you have physical nexus, so like salespeople visiting a state, or economic nexus, let's say $100,000 or $200,000 of sales in a state, then you're responsible for sales tax. I think where the difference is around kind of corporate income tax. So there may be income tax issues with selling from Canada. you won't get double charged, but you may have to register in numerous states for income tax, and they will they will share kind of profit share across those states. So you won't have to pay double tax, but there may be income tax if you're making profit in the US.
Josie's just asked in the chat for a bit of clarity around taxes in the US, if they're primarily on B2C, not B2B. They sell to farms. So if a farm is not registered or it's / incorporated, would it be considered B2C? Ben, I don't know if you've got a take on that.
But yeah, that's a great question, because yeah, you don't know the status sometimes, of who you're selling to. Like if you're mid-market enterprise B2B, I've been in B2B, so even B2B, I'm still aware of where I'm selling, what I'm offering, and there it's a little easier, right? Because say you're signing an agreement and it's an Inc., an LLC, whatever it might be. But yeah, that could be harder, if you don't know, the entity status of who you're selling to.
And another question come through from Rob. I'd love to hear about the Vda process overseas. I'm quite familiar with US jurisdictions, but would like to hear about EU, Australia, Canada. Hugo, I guess that's one for you.
Yeah, so there isn't really an equivalent of the Vda. So I guess for those who aren't aware, that in the US, if you go to a state and haven't been registered for sales tax, you can enter this kind of voluntary arrangement where you effectively limit your back tax liability to, I think, 3 years of sales, and it's a kind of a regular process that you can use across any of the US states, or at least most of them. In other jurisdictions, that concept doesn't exist. So if you've triggered a threshold in the UK, for example, and you've got 17 years of back taxes, you have to pay 17 years of back taxes. There isn't a negotiation to be had with the tax authorities. But I guess that with Europe, most people are compliant or have been compliant. It's kind of easier to be compliant than it is in the US. I think with the US, the government or the states kind of tacitly recognize that it's such a nightmare and it's so difficult to be compliant that, in fact, they give you a mechanism to be compliant so that they can get their hands on your tax dollars for the last 3 years and going forward.
We've got a couple more questions. I just wanted to take a moment to encourage anyone who has a question they might sit burning with to please do share. We had a few questions sent in on registration. One of them was somebody interested in non-credit card direct debits in various countries, and if this is possible. Sort of a tangent to tax, but as we've got your attention.
Shall I take this one? Yeah, I think from a tax perspective, I mean, absolutely, you can take payment by any method. I'm not aware of any tax jurisdiction treating that in a different way to any other payment type. I mean, you're still selling a good, so yeah, I think that it's probably a good way of getting recurring billing for, particularly in Europe, or in the UK with like direct debit, and Europe with SEPA. But yeah, the tax treatment, as far as I'm aware, is the same.
And we've got, I believe Dave C might be one of our customers. He has a very specific question. This one will be for you, Hugo. If Paddle's exempting him from his company from collecting sales tax in the 50 states, does that mean that he's liable for paying taxes in each state separately, or do we continue to shield him from handling it all, and he just gets a paycheck for which he owes federal income tax?
Yeah, so if you sell using a kind of reseller model like Paddle or merchant of record, then because the merchant of record is making the sale to the end customer, we take on all responsibility for sales tax globally. So you don't need to worry about sales tax. For income tax, that is a separate thing. So that would be something that you need to take advice from your tax advisor, depending on your profit in the US. In other countries that wouldn't be applicable, but in the US, once again, there is a separate kind of Nexus kind of scheme around income tax. So yeah, I'd encourage that you have a look into that if you're making lots of profit in the US.
That's all our questions at this point. I believe we have a short poll for those of you who are still with us. Bianca, do you want to ping it up? How do you currently manage sales tax? So we'll see if we have as many NAs, Ben, as you did for for your survey. We've had another question come through, but I'll hold off until we've given a moment for people to vote on this. Can sales tax compliance have an effect for VC/PE-backed organizations? Can there be repercussions when it comes to raising future funding, or if we were not compliant prior to raising? Hugo, do you want to take that?
Yes, yeah, absolutely. I think, well, there are probably two inflection points here. The first one is if you're looking to raise money from a kind of professional investor, and it may not be VCs so much, but yeah, certainly like growth investors who are kind of more kind of hot on compliance, let's say. If you have been selling in a non-compliant way into jurisdictions and there is a big back tax liability, then they will obviously see that. Whether it has an effect on value, I suppose, depends how material that is. I think the other inflection point is around IPO. Like you see a lot of companies when they go out to IPO, doing a lot of backroom deals with the revenue across the globe, because they don't want to have any kind of legacy liabilities as a public company. So it's quite common for companies when they're prepping for IPO to be settling historic liabilities behind closed doors.
Yeah, and Hugo, I think, in the US, if you're going through due diligence, sales tax is going to be on that checklist. So they're going to want to know, where do you remit? Why don't you remit? Why don't you think you need to remit? So if you're raising funds, if you're exiting, it's going to be on that list, and you're gonna have to address it at some point.
Do you have any public examples of that of interest that have hit the press in your time, or does that all happen just behind closed doors so nobody would really know?
Behind closed doors, yeah.
Great. Well, that's our time. We had a couple more questions come through, but we'll answer those following this session. Thank you so much for joining me today, and hope you both have a lovely continued day.
Thank you very much.
Bye.
And to everyone listening, we will be sending out the recording of this in case you want to reference back or share it with anybody. So we'll be in touch. Thank you very much.